In a week that's seen some jitters throughout US equity markets, we enter a new week that is going to be dominated by earnings because we see 5 of the so-called Magnificent Seven reports. Crucially, the first of them reported already, and that was Tesla. We saw a massive beat, certainly on the earnings side of things, and that has lifted sentiment throughout some of the tech names. Will we see the 5 reporting this week doing the same kind of thing? And will that provide the basis for people to be able to look at this earnings season and think it's been a success? Time will tell. But within this video, I'm going to take a look at 4 of those names as we preview the week for earnings starting Monday, the 28th of October. So first and foremost, let's just look at the numbers. This is Microsoft first and foremost, and we can see that essentially what we're looking at here is a expectation that we see earnings and revenues increasing at a pretty hefty clip over the coming years. These are annualized or annual figures. So 1180 on the 2024 earnings per share expected to get up to 20.66 within 2028. And then we're looking to get from 245 up to 422. So an expectation that we see a ramping up in terms of both earnings per share and revenues at a relatively consistent basis. It's notable that if we're talking about these companies, there's a lot of expectations around AI, of course, and that has been the basis for a lot of the outperformance that you've seen for big tech. Now, we're not necessarily seeing an expectation that there's going to be a single year or a single period in the future where we suddenly see a massive ramp up in terms of earnings, presumably to do with AI. Instead, it feeds in as part of their package and hopefully should help drive increased revenues and stickiness for their products going forward. But there's not an expectation that they're suddenly going to see this new product that hits the market and is creating a whole new massive new revenue source. In terms of the quarterly numbers, well, you can see here things are relatively stable as well. We don't see sort of wild swings, and we're not necessarily seeing a massively sort of cyclical business either. Instead, you're seeing sort of steady incremental gains and stability at each new level. So we can see over the course of the 2024 sort of financial year, you can see in terms of earnings per share, 299 for Q1, 293, 294, 295, and then expectation that we see 310 this time around. The first time we'll break through that 3 barrier on this period. And certainly that is notable. I mean, look, if you see from the prior year, we were looking more like 232, 240s, 269s. Then we jumped up into the new year and we're around the $3 mark. Now we're jumping into the new fiscal year, 310, 324, 328, 342. So that steady incremental yearly move towards the upside is expected to continue. And then we look at revenues. Revenues stay stable, you would say, expected this time around. 64 is expected once again, in actual fact, expecting a decline. But what's notable here is that we do see outperformance in terms of the company's actual numbers versus the expected. You can see out of the 7 that we've seen on the top end and 7 on the bottom, we've only got one occasion where we missed, and that was Q2 2023 on the revenue side of things. So generally we see beats, but we don't necessarily see massive beats. You've only got one example out of all of these that is a double-digit beat on Q1 of 2024 for the earnings per share figure. So maybe not necessarily going to see the same kind of sort of huge volatility that you might see for some of the others that come alongside that. If we're looking in terms of, say, the performance of Microsoft against some of the other names that we're looking at this week, well, we can see that here. So we can see that since the back end of last earnings season, Microsoft has actually been a relative underperformer. You've seen sort of around about mid-September down to the back end of October, sort of 21st. All we've seen really from this green line here, which is Microsoft, is declines. And we've seen it pick up more recently. You can see on the 22nd of October, we saw a gain, and we've been sort of fading a little bit from there. But certainly, you know, if you're looking at the trajectory of these stocks, they're not all moving in tandem, and that is notable. We're actually seeing some sort of inverse correlations between some of them, as if you might see some funds and capital shifting from one to the other when people see value. Meta certainly outperforming significantly off the back of last earnings season. And then we've seen it fading recently, coming at the same time that those companies that had underperformed, the likes of Amazon, the likes of Apple, then started to bottom out and pick up once again. So we're seeing narrowing between some of these names that are reporting this week. But notable, between Microsoft and Amazon, neither of them are up over this period. I'm essentially drawing the back end of last earnings season from the report from NVIDIA. So, you know, ultimately, if you're looking at a company that hasn't necessarily performed all that well over that period, you could view it from the perspective of saying, well, you know, trend-wise, it's sort of floundering a bit. Or you could look at it and say, well, we haven't seen a ramp up in price that would lead us to think that their sort of valuation, the price to earnings, are sort of not damaged, but have worsened in any way or have increased to any significant degree. And here's the chart. You can see that by and large, we're looking at a company that has been in consolidation mode. We saw that big run up in sort of April, May in particular, where it started the bottom from April, and then we moved up to the peak here in sort of early July. And we saw that significant decline here. If we look at, say, the weekly time frame, though, we can see that actually this period of consolidation, this tightening price action, does really play into sort of a wider bullish trend. Of course, well, we've got this symmetrical triangle that should give us a clue of where we're going from here. And that would come with a breakout through either the top end or the bottom end. The more recent sort of wider levels here are your 400 mark and your 441. But then as we sort of increasingly create these higher lows and create these lower highs, then you find new levels. So if we do see some downside coming into this report, you know, as long as we don't break the 408 level, then it looks like that could potentially be an opportunity for the bulls. We have, of course, seen this sort of bottoming out recently with this pullback into a deep retracement, which we can see here is probably even beyond a 76.4 fib. Let's just grab that on and see exactly where we came into. So it came into the 76.4 fib level there. And then we bottomed out here. We can see here in terms of the daily time frame that there's going to be some sort of basing pattern here. So here we go. So we can see it on the hourly time frame with greatest clarity, sort of bottoming out here, creating that higher high, but then seeing a bit of chop on the bottom end. Once we see that break up through resistance, which takes us back into trendline resistance. We're pulling back at the moment. I think there's a good chance that we do see this as a potential setup for the bulls once again. But certainly if we start to break down below, of course, that 408 low, but also your 413 level, you know, a break below 413, well, you're still looking at the potential for trendline support to come in. A break below 408 necessitates the breakthrough trendline support as well. And that would point towards a wider period of downside for this stock. But for me, we're looking at a very clear-cut trend. We've seen a pullback, but this arguably provides the breather that many people wish they had got into, right? People like to buy the dip rather than just buying something that's run away. It certainly isn't within a runaway stage at the moment because we've seen this pull back into your 76.4 fib level. And so I think there's a good chance that we do gather some momentum, like I said, from the perspective of the numbers. And I can show it once again. Time and time again, they beat estimates. So if they do it once again, then there's a good chance that we do see this consolidation period at the moment as the potential for the beginning of that next move higher for Microsoft. Meta now turning our minds to a company that really has its finger in many of the most popular social media platforms, of course, the likes of Facebook and WhatsApp and Instagram, and heavy reliance on that, and particularly on advertising revenues. Well, from an annual basis, you can't necessarily say that this looks exactly like Microsoft, because what we have seen is sort of figures around, you're looking over recent years, sort of 6, 7, 6, 10, 13, 8, 14. We have seen significant fluctuations over the course of COVID. We've seen it over the post-COVID period where we saw that massive boom in terms of inflation. Certainly, there had been some big question marks around companies' willingness to pay as hefty prices for advertising revenues. Well, it appeared that 2023 sort of marked the end of that. We did see a outperformance over the year following 2 years in 2021 and 2022 where we saw underperformance. in terms of earnings per share in particular. And then, if we're looking at 2022, where we saw 859 for the year, and you look forward to the end of this year, where the expectation is that this year is going to come in at 2137, that's a massive improvement and way over and above anything we've seen before. So there's an expectation that we really reach a whole new level of profitability this year. And then we push through into 2025, where we see 24, 45, 28, 31. So, this does feel like a transformative year. And if we look at revenues, by and large, you don't necessarily see as much volatility coming through here. You can see sort of 117, 116, 134. But then we're looking to see, again, 161, 184, 207, 232. So certainly then it's an expectation that we see that ramping up over the years to come. In terms of the quarterly basis, we can see that we generally have seen outperformance, and we've seen a couple of really strong quarters this year. And we saw the back end of last year with two particularly strong sort of outperformances. So the last four readings have come in 20% higher, 10% higher, 9%, and 9% higher than expectations. So really significant outperformance versus market expectations over the last four earnings per share. Are we going to see it once again? Well, 521 is only marginally above the level that we saw for Q2, and also below the figure that we saw for Q4 of last year. Of course, it has some cyclicality to it. So you can see generally the peak is Q4. But, will we see Q3 manage to replicate what we did for Q4 of last year? And then that builds the basis for an even stronger end to the year when we see the Q4 figure. But certainly we're looking at a company that's outperformed estimates on the last 7 occasions, and the last 4 of them have been really major outperformance in terms of earnings. On the revenue side of things, expectations of 40.19 billion, up from 3907. You can see there's some fluctuations, but if we look in terms of Q3 of last year, 34.15. So that'll be a very healthy increase if we get up to 40.19 billion. And then moving on from that, there's again some cyclicality to it, but as an expectation that, again, Q4 is when they do their best business, 46.18 expected. But I would draw your attention to the fact that we have a company that is relatively cyclical in nature. We generally see things peak towards Q4, but we generally see it ramping up over the course of the year. So if we're looking at 516 last time around, generally we see Q3 coming in well above that of Q2. This time around, the expectation is that it's going to be very similar. So is that providing the basis for outperformance once again? Hopefully that is the case. And let's look at the chart and see exactly how things are shaping up from that perspective. And we can see that essentially you're looking at a company that, from a long-term perspective, has of course been a big outperformer. We can see that over the course of this period here, we've essentially seen sort of consolidation. We haven't necessarily moved a huge amount over the course of 2024 from sort of late January. So let's say February through until this recent breakout in mid-September. We've been seeing price action sort of chopping around. We haven't necessarily seen, the same kind of upward trajectory that we saw here back in 2023, here in the back end of last year, and the beginning of it when we came into January. That trajectory has stopped, but we've finally seen that breakout. So whilst we're pulling back at the moment, we're into the third week of downside. Are we going to see earnings that provide the basis for us to bottom out once again? There is a good chance that what we're looking at here is some people taking chips off the table ahead of an election. And so for all of these names, you might find yourself in a position where the company posts good numbers and the stock, maybe it bounces initially, maybe it doesn't. Maybe we see it holding off. And that could ultimately provide the basis for you to see a company that you think, well, markets are essentially waiting for the result of the election. But arguably, irrespective of what happens in the election, there's a good chance that it's going to, you fast forward a month down the line, the market's going to do what the market does, right? I think there is a lot riding on the election, but at the same time, if you look back historically, the performance of the S&P 500 is generally good, irrespective of who is in charge at the White House. And so, You know, generally when you see companies that are great companies and they're outperforming, they're posting very strong numbers, when there's something unrelated to that that is holding back the share price, that can often be an opportunity for the bulls to get in at an advantageous price and wait for markets to essentially forget about what the main story is of that moment in the news. Nonetheless, near term, of course, we are seeing some weakness, and the 4-hour chart highlights that with the breakdown through this initial sort of area of support, your 5, 6, 8 level in particular, acting as almost like the right shoulder neckline here of a head and shoulders formation. And so we're fading a little bit at the moment. I wouldn't be surprised to see further downside over the near term. But as we head into these earnings, we're talking about a company that has outperformed for much of the past 2 years, and certainly coming into a period of time where businesses are starting to likely feel a little bit more optimistic as we see rate cuts coming into play, and we see the possibility of a government and central bank that's going to be focusing more on US growth and less so on driving down inflation. So that should benefit some of these companies going forward. On the same kind of topic, you know, Apple, we're talking about a company that has plenty of fear around it, given the worries about the possible recession that people have been talking about not so long ago, what's happening in terms of China, what's happening in terms of US-China relations. There's plenty that goes into it. But nonetheless, we're talking about a company that, once again, continues to move up and up and up in terms of their earnings and in terms of their revenues. And you can see here in terms of expectations for 2024, 671 expected. That marks a notable rise up from what we'd seen in the past 2 years, where 611, 613. So we'd seen it sort of flatlining over the past couple of years, in no small part due to what's happening in China, really. But things hopefully will start to move as we see these stimulus measures potentially feeding into consumer sentiment over in China. 383 is the revenue figure for last year. This year, 390, then 419, 448, 474. So expecting to see some pretty healthy gains in terms of the revenue side of things. Now, in terms of the quarterly numbers, what we expected, 159 on the EPS, 94.36 on the revenue side of things. What have we seen over previous quarters? Well, we've seen outperformance generally, essentially 6 out of 7 that we can see on the earnings side of things. We've seen outperformance, and the same could be said for revenues. However, we don't necessarily see huge outperformance. You're seeing sort of 4%, 1.6, 3.77, 4%, 5%. So no double-digit outperformance metrics. And this time around, 159 expected. If you look at Q4 of last year, 146. So there is improvement on last year. But again, sometimes, you know, I think look at these things and think, well, you're talking about a baseline that's potentially easier for them to be able to achieve and beat. And so when you see a figure that's not necessarily that much higher than, say, the previous year, then you're looking at the possibility that they've sort of crafted expectations to the extent that they can beat. And that's what we want, right? I mean, ultimately, markets just seem to care about, are they beating on revenues? Are they beating on earnings? And what's the outlook, right? Those are generally the 3 immediate things that people look out for. And so when you're creating a low bar to be able to overcome, it does provide the basis for you to outperform. And then it comes down to the outlook from the CEO. And, you know, as we move into a year that's going to be dominated by easier monetary conditions and potentially a Chinese growth story, then you have the possibility of Apple doing well. Of course, you've got question marks around trade relationships between the US and China. But then at the same time, when you have companies that have factories in China, you know, there's a possibility that some of this can be, you can get around it essentially. In terms of the share price, Apple chart, as we can see here, has pulled back into trendline support alongside the weakness that we're seeing for some of the other names. It's been faring really well. Ultimately, you know, we've got an upward trajectory that can't necessarily be said for all of these, because you can see that we've sort of pulled back into this consolidation for Microsoft. We've sort of seen this topping out in terms of Meta. But in terms of Apple, we have got this steady ascent as it climbs and climbs and climbs. So the pullback that we're seeing at the moment, I'm sure many will deem this a buying opportunity. We've got this 221 level that provides the swing low that, if broken, would end this upward trajectory. And until that happens, I think there's a good chance that the bulls come back into play sooner rather than later. A lot of this will come down to wider market sentiment, but you're talking about an incredible company that's expected to continue to grow as we go forward. And so this pullback into trendline support does give us a very interesting point in time for us to be able to see whether the bulls come back into play once again. You can see this decline has taken us roughly into the 61.8 Fibonacci level thus far. And then if we look at, say, the hourly time frame, we can see that sharp decline coming into play. We're trying to regain a little bit of ground. That does look like it could potentially end up sort of working out into a flag formation. We'll have to see exactly how this plays out. But nonetheless, we still have got that trendline support playing in for the moment. We've got a very clear uptrend over the long term. This is the monthly time frame, very clear uptrend. And so, let's hope that the earnings provide the basis for another bullish phase for Apple, and through that, generally, that should provide the basis for a bullish phase for equity markets, in particular the Dow, which doesn't necessarily have all of the big names within it, all the big Mag 7 names, but it does have Apple. So that provides the basis for upside for the Dow if we do see a period of strength coming into play for Apple. And finally, we're looking at Amazon, and Amazon reporting on Thursday, the 31st, expected to see an annual figure of 473, an annual of EPS, an annual revenue figure of 635. In terms of expectations versus where we are at the moment, where you're looking at 290 and then 473 for this year, right? Then 580s, 730s, 890. So an expectation that we do see pretty hefty gains over the coming years in terms of earnings. Well, from that period, we also have an expectation of strong revenues growth as well. It's not just margin. So 574 expected to rise up to 854 into 2027. Now, in terms of the quarterly numbers, we can see 114 expected on the Q3 earnings per share, 157.27 on the Q3 revenues figure. Crucially, if you look at the performance versus expectations, we've been seeing really significant outperformance for earnings for Amazon. And so this shows you that, in particular, if we see a company that is sort of has relatively low expectations this time around, then you think, well, they're just trying to set it up for the same thing that's happened time and time again in the past, right? So 114 expected this time around. That's down from a Q2 figure of 126. If you look at Q2 versus Q3 of 2023, we actually saw a significant decline, a significant gain, whereas this time around we're expecting to see a decline. So it's not necessarily just a cyclical thing that we see a decline in Q3 over Q2. Are we seeing a relatively low threshold, expected threshold? I would say so. If I'm looking back at some of these previous figures, so if you look at the reported versus the estimates on the earnings side of things, right? So Q1 of 2023 coming into Q2, so 31 cents to 35. So expecting to see a gain. Q2 into Q3, 65 down to 59. So an expectation that it declines. Massive beat. 94 expected to drop down to 79 cents. So again, expecting a decline. Massive beat up to $1. $1 expected to drop down to 84. Big beat, 98 cents. So it seems like time and time again, they've managed to massage it into a point where they told the markets they're going to see a decline in terms of earnings per share, but they keep beating it pretty much each quarter. And once again, markets are expecting to see a figure of 114 down from 126. Are we going to see a figure above the 126 number? If you look at previous instances, you'd say that that is a distinct possibility. And then if we look at the chart, let's see exactly how we've fared off the back of some of these announcements. So you can see here, big outperformance, big jump that we saw in sort of January coming into February. Back in April, we can see that it essentially marked the bottom around that time. We did see a significant pullback here off the back of the August earnings report. This time around, we're trending upwards from that bottom. We've pulled back into what looks like a retracement and starting to see the bulls coming back into play. A breakdown through this near-term swing low of 180 would point towards a sort of wider rolling over of this stock. But certainly, if you look at what they've done on the EPS side of things, most notably, they have done particularly well. For me, we're talking about companies that have generally spent a lot of money on AI, but have reaped very little benefit. Now, that to many people puts pressure on them to prove that the money that they've spent is well spent, right? And to some extent, I agree. But there's a flip side to it. If these companies can continue to beat market expectations on their earnings, on their revenues, and that comes amid a lackluster or non-existent boost in terms of their AI offering, when we do finally see that AI side of things, all of that investment sort of kicking in and providing ramping up in terms of revenue streams, that provides a potential tailwind for things rather than just saying, oh, well, they've got to prove that all this money that they've spent is worthwhile. Yes, but at the same time, markets are happy as long as, you're continuing to outperform on your numbers. And if you're outperforming on your numbers and you're yet to see the full benefits of all of this investment that you're doing on the AI side of things, it does provide the basis for us at some point soon enough to see that coming through and to start to really ramp up expectations in terms of future earnings, future revenues for these stocks. So we were looking here at a company that, of course, over the long term, we have got an outperformer. We've seen some jitters recently. We've got question marks about, are we going to have a recession? Things like that. That appears to have faded. The US consumer, is it strong enough? Well, I think generally it is. I think generally we're likely to see a strengthening of the US consumer as we go forward. Monetary policies on our side. The wider trajectory for big tech remains bullish in my mind. And so whilst we might see some jitters around this US election, I think that once we see dust settle, whether we see the initial reaction post earnings in relation to how the earnings come out, or whether we see for those companies that outperform a little bit of hesitation because people don't necessarily want to go in a big way ahead of the election. Whether it plays out any of these ways, I think it's a good chance that most of these companies are going to continue to outperform as we go forward. People are always fearful of buying into strong companies and want to try and buy into weak companies on the presumption that they've got to have a catch-up play. If you look back historically, these big growth names, big tech names, they are valued the way that they are for a reason. They are very reliable performers, and ultimately they have the firepower and the willingness to take advantage of this new wave that is going to be AI. You can look back at previous instances and say, well, the big companies, from when I was growing up, used to be very different companies from the ones that are now heading up the, S&P 500. But the difference is here that we've switched from one type of company into another towards tech, right? With the dot-com bubble and all of these big tech names coming into the fore and social media and the like. Well, this new development within AI, many people will say it's going to be new companies that come through that are going to really provide the basis for the big outperformers. That may be the case, but at the same time, there's going to be very few companies out there with the firepower to be able to compete with these big names. And when they've got the chips and they've got the willingness to do it, any company that tries to come out with a new product around AI that they think they could do, they're likely to either buy it or they're likely to copy it and do something very similar. And so, this AI boom is only just beginning. These companies have invested in a heavy way. We haven't necessarily seen the fruits of their labor, so to speak. Doesn't mean it's not going to happen. It doesn't mean it's a dud. It means it's a long-term trend, I think. And, I think as we move into this week and everyone's going to be talking about big tech and are we finally going to see those AI revenues prove out? Well, it remains to be seen. But just because it doesn't necessarily come out and we see it, huge amount of revenues coming specifically for AI doesn't mean that we're not ultimately looking at companies that are going to be some of the main benefactors of this absolutely massive technology that no doubt will become central to our lives in the future. So big tech, that's going to be the theme for the week ahead. I mean, there's a huge amount of other companies reporting. We've also sort of rounding off the week with the likes of Chevron and ExxonMobil with a view on the energy markets. But yeah, it's all going to be about big tech, and certainly where big tech goes, the market appears to go. So let's hope that that they continue to outperform and do well in terms of their earnings and provide strong outlooks, and that can hopefully provide the basis for a strong market going forward.